So we basically discussed in the last class about R, T, T, L, L, U, where I said the first one is return. It is important to understand if it is absolute versus some reference return that he is looking for. Anything which sounds very absurd or unrealistic, it's good time that we should educate the investor.
Hmm.
This is the most important thing, which is the risk. Again, I said that there are two things. One is ability and other one is willingness. So even though you have high willingness, looking at the other people, your actual money that you have in your hand really decides if you have the ability to invest into risky assets or not. And then I said time horizon. Again, this time horizon is very much in line with your risk appetite. You have a high time horizon. You have, you have a high risk appetite. You have a low time horizon where I say low time horizon, it means that you would require money soon, maybe in a year, maybe in 2 years, maybe 6 months. So by that, I mean that the time horizon is low, which means you will need more of liquidity. When you need more of liquidity, it means you will not be able to invest in risky assets because risky assets has more volatility. More volatility basically means more variation, and it takes time to recover. Just in case there is a downfall, it takes some time for it to recover. So to fix it, not to fix it, but to really to not get into those kind of securities if you have time horizon which is low. When it comes to taxes, the basic thing that we can say that if you are heavily taxed, right? In that case, you can invest into tax-free assets. If you are at a low tax bracket, then you can go for taxable instruments. But that's all that we can say. We are no tax experts. When it comes to liquidity, again, very much in line with the time horizon. You have high liquidity constraints. You have low risk appetite. You have low liquidity constraints. You have high risk appetite, right? And it is very important that the investment manager should manage the liquidity requirements of the investor, because that's the basic goal. Think about this, that we usually, and I have done it myself, that let's say I have a credit card bill of 3 lakh rupees, right? And I know that I have effectively, think about this, right? I have to make a transaction for 3 lakhs. I can do it right away from UPI net banking versus I can use a credit card. Assuming there are no additional costs from the credit card, right? I can swipe from the credit card first. I can get the reward points, whatever it is. Secondly, think about this, if that's a first day as in you just got the bill last night, which means your billing cycle started, and you do the transaction. So effectively, you will get 48 days to pay that amount, 3 lakhs.
Yeah.
Right? So on those 48 days, what you can do is you can invest those 3 lakhs maybe in some liquid fund, right? And then just to ensure that, okay, on the 18th or 17th day, you should get your money so that you can pay the bill. So you can redeem it on the 11th or 12th day, basically the 40th or 41st day. So that you get your money on the 46th or 47th day, and that's how you will be able to pay your money, and you can get some extra return. But the idea is that when you have high liquidity constraints, you can only be able to invest into liquid funds. As I said, you can invest into Nifty fund or etc. that has high liquidity, and the exit loads are low because you have a high liquidity requirement. So even though their return is pretty low, you have a bigger constraint of liquidity, so you cannot invest into risky assets. Right? Another one is legal. Again, as I said, always follow the stricter of the 2 or 3. But first and foremost thing that you should always keep in mind is the local laws. Right? You cannot get away with the local laws. If you are living in Singapore, but you are an Indian, while things could have happened differently in India, you can't be arguing on that thing. If you are in Singapore, you have to first follow Singapore law. And the last one is unique, right? As I said, it could be anything. This is very generic. And if there is anything that you want to mention, maybe you have a high investment in real estate, maybe you don't want to invest into something, maybe negative screening, maybe positive screening, maybe your one of your friend, not really friend, but somebody you know actually met an accident because he was drunk, right? So from that day you said, okay, no matter how much return I'm going to get, I'm not going to invest into liquor companies, because at the end of the day, when I'm investing into liquor companies and I want my stocks to go up,
Mm-hmm.
indirectly I want my liquor companies to perform well, right? So that's a kind of negative screen. So in case the liquor companies give you 200% return, doesn't matter. There's some kind of a unique situation to me where I am saying that, okay, no matter what, I don't want to invest into liquor companies at all.
Mm.
All right. So these are the RRTT, LLU. Then they also
Yeah.
talk about in your real world in your topic, there's something called as asset size that we covered already. That there are things that sometimes your fund is too small to invest into a bigger fund, where the minimum requirement, let's say, is 500. So I give you example. Let's say you invest into a fund that has a minimum quantity, minimum amount is 500, while your fund or your total value of the fund is only 300, right? And then there are other funds as well who has value of only 50, 10, 20, 100, right? So in such scenarios, you guys can come together. These are small funds. You guys can come together and create a commingled fund, or in simple language, I can say you can do a kind of pooling,
Mm.
right? And that's how you can invest into the bigger fund. The opposite is also true, where you have a situation that your fund is too big, right? And you will not be able to accommodate your fund in that investment product. Although, as I give you example of small cap uh, fund, where I had 10 lakh, but I was not able to invest because it only takes 25,000 per PAN per month, right? So there was no way that I could invest into a small cap fund. So these are the basic size issues that they talk
Yeah.
about. And then they talk about liquidity issues, right? In terms of liquidity, I've covered everything, but let's just quickly look at the table and let's just understand if we are in line. Look at this one. When it comes to liquidity, it says for the banks, the typical liquidity need is high. Do we understand why? Because in banks,
Yeah.
they will always have to keep the liquidity high so that if anybody would come, they will be
Yeah.
able to pay the money. Think about sovereign wealth funds, endowments, pension funds, foundation. You can imagine that these funds, especially foundations, endowments, these are long term, right?
Yeah.
And it's just that their minimum obligation is to invest, I think not invest, to distribute 5% of the total income to have
Mm-hmm.
a tax status, right? But overall, since there are no obligation, they have a long time horizon and lower liquidity needs. Now, if not in this topic, there could be some other topic that they're gonna ask you this, where
Yeah.
they said that somebody's gonna somebody set up an endowment. So when you read the word endowment, it gives you immediate feeling that okay, this is gonna be a long term, and the liquidity requirements are low, right? So the risk appetite is high. But when you're gonna start reading that whole paragraph, you would realize that they are saying that this endowment has been set up for a college, and all the college expenditures come from that endowment, and the college does not have any other source of income. You understand what happened here?
Yeah.
So even though that's endowment, even though it should have a long term, but then since the question says that it is taking care of all the expenses of a college, which means that you would require regular income from the endowment, which means that now it will not be able to take risky investments, right? Because the liquidity requirements are now high,
Mm.
right? So I'm saying these are the very generic rules, but in case the question changes, you need to accommodate your answer with that, right? Think about property and casualty. Again, the liquidity requirements are high. Again, you don't know where the accident would come, what natural calamity would come, and you have to keep the funds ready to accommodate that claim. Okay. Life and auto insurance, relatively low, right? A lot of candidates, they have questions on this when I teach this. They say, Ankur, लाइफ का भी तो कोई भरोसा नहीं है, anybody can die.
Hmm.
So why do you have low liquidity requirements? It should effectively be high liquidity requirements.
Yeah.
And I said, your thinking is right in a way that life is so unpredictable and anybody can die anytime. But the point is that when they give you a life insurance, they create mortality tables, right? And you would read this somewhere else in your level 3. So basically, they create mortality tables. They look at your overall history, right? Your grandmom, your grandfather, your parents, how much they have lived in their past life. Then your eating habits. Then your job, etc. Right? So basically, they create a matrix that covers each of these components to understand how much your life expectancy is. Let's say it is around 85. Looking at your parents, looking at your lifestyle, looking at your eating, drinking habits, right? And your whole family background. So they realize that your life expectancy is still 85. Now, when it comes to 85, they pretty much assume that either it's going to be 80 or maybe 82 or maybe 88.
Hmm.
It is highly unlikely that something could happen at 40, right?
Yeah.
While there could be situations where somebody's life expectancy was 85 and he lived till 90, and there could be scenarios where somebody life expectancy was 85 and he lived only till 80. So kind of it balances out, but pretty much it usually doesn't happen. You would have seen also in your nearby, in your relatives, etc., that at least in your hierarchy, your grandfather, your grandfather, if somebody has lived till 75, your grandfather would have lived till 78, 77, 72.
Mm-hmm.
These things, these things are changing a little bit these days because of the high stress level and heart attack and whatnot.
Yeah.
But pretty much, I can tell you from my grandfather and then my grandfather, they all gone pretty much at the same age.
Mm.
Okay, that's how they say. And then individuals, it again obviously it varies depending upon what liquidity requirement does he have. It will keep on varying. Right. Next one that they talk about is time horizon. Again, something that we have covered already. Right. They look at a question. One second. Okay, in fact, I should be covering this so that you would know what's going on. In time horizon, I just want to reiterate one more thing. There's another factor of there's a factor of human capital.
Mm-hmm.
There's another factor of human capital. When you are young, when you are in your late 20s or early 30s, right? Your risk appetite is too high. So I can say that basically there are some kind of rules that they say that okay, you can invest into if you are at 20, you can invest 80% into equity. So this will be 100 minus age.
Mm.
Right? And if you are at 80, then you should invest only 20% into equities and 80% into fixed income.
Mm-hmm.
Right? So I'm saying human capital, which is being represented by humans and then the work that they do,
Mm-hmm.
right? It also depends that at what age you are. You have the larger age, basically if you are in your late 50s or 60s, we assume that the time horizon is low from your retirement, and then we tend to invest into less risky assets than in a situation where you are in 20s,
Got it.
right? So even that thing should be taken care of. All right, let's look at this one.
So his time horizon is. So we have to comment both on liquidity and time horizon, or just time horizon.
Both.
So in terms of his liquidity need is high because he wants to maintain a constant standard of living to age 85. I think post 70, he doesn't have any human capital. It will just be sort of investment capital. And then he also needs to make sure that his investment capital has enough money so that he lives a constant standard of living from 85 to 100. So his time horizon is like 15 years. That's not high. Right. So his liquidity is high and his time horizon is also time horizon is low.
Yeah. So one thing is, when you look at this sentence as he's 70 years old and he wants to maintain a constant standard of living to age 80, 85, it means that your whatever investment that you wanna go for at least goal one, you should invest into something that has no risk, pretty much. Right? So basically, I would say my goal one should be fully funded. What does fully funded means? I cannot take any risk. Right? But when it comes to goal two, to maintain a constant standard of living, abhi he's just 70.
Yeah.
Right? Who knows whether he is not able to live up till 85 or maybe more than 85. So at least looking from now, when he's at 70, I still have 15 years to play around with. From a starting goal, which is 85 to 100, I still have 15 years to play around, because whatever investment that I'm gonna do will be effective 15 years from now. Which means to accommodate my goal two, I have got some leeway that I can invest some portion in my risky assets or long-term assets. But at least in terms of goal one, we want to ensure that everything that we do is into fully funded status. Is that okay?
Yeah.
Okay. Look at this one. And I'm going to show you that they don't have any specific answers. It's just that to give you an overview of how you should think about these things. Let's go through this.
Okay.
And what do you understand from this?
So,
So can we say Jane and Arthur are both 52 years, working as lawyers. They have a daughter, Alice, age 16, and a son, promising age 27, who aims to run for mayor in 8 years. Okay, and he's 16. So imagine that he would be going to college maybe in 2 years, and he would be running this in 8 years. The financial situation allowed it, they would like to make a donation. Okay, if they also are thinking of donating something for the campaign, they also would like to set up a scholarship at the local school to fund talented children. Okay. Ideally, they would like to do this when they are 80 to celebrate the 40th anniversary of Arthur setting up their own practice. Okay. So this is like a very, very long term. From 52 to 80. Look at this. Funding lifestyle and consumption needs. So whatever lifestyle that they have, they want to maintain it. So is it right to say that at least for lifestyle and consumption, the investment should be very conservative?
Yep.
Right? In that case, in that case, I cannot invest into risky assets, because if that doesn't perform well, I'll have to go below my standard of living, which I don't want. Right?
Yes.
Next one is college education. Again, this is also coming up pretty soon, right? So, and this is mandatory. So I really cannot risk here. Again, it's just 2 years now. Donating to mayor's mayoral campaign. In this, we have at least 8 years. It's a little far-fetched. So I think I can be a little aggressive here in investments. Right? In terms of scholarship, he is saying scholarship kab karna hai? They would also like to set up a scholarship at the local school to fund talented children from the underprivileged. Ideally, they would like to do this when they are 80. So again, we have a long term, very, very long term. They are 52. 28 years from now, they are thinking of setting up a scholarship. So again, obviously, this is a huge long term, right? So I can say that I'm going to show you a table that talks about how much allocation that they're going to do. But if you look at this, these are all arbitrary numbers. You cannot argue. Well, you can always argue that Ankur, to maintain, you have put 60-40. Why not it is 55 and 35? It can be. This is when you said that it is 25-75. Can you do 30 and 70? Very much. So, so the idea here is, and this is the kind of question that you're going to get in the exam, where they would not really want you to calculate or to get to the exact percentage. But the idea is that, do you understand that the weighting, the biasing is more towards equities versus fixed income? Look at this. When the goal is minimum, where he has to maintain the lifestyle, etc., you have 100% of the bonds. While when you have a college fund, again, conservative, you can't take a lot of risk, 100% of the bonds. But when you have campaign donation, it can be aggressive. When you have a scholarship, it can be aggressive.
Yeah.
Right. So they say that overall, if I look at everything, I could see that most of these things are mandatory for them, where I would have to have standard of living and then education and then whatnot. So these things will require my more allocation into fixed income, which is bonds. So they did an allocation of 75% bond, 25% equities, and this is what the total portfolio weight in that. But there's no way that you will be able to calculate these numbers, and this is just to show that anything which has a higher, longer time horizon can take an aggressive approach, while places where you have to maintain a lifestyle or you have immediate liquidity coming up, you should be more conservative in your approach. Is that okay?
Yeah.
And then they also say that allocation keeps on changing, right? And in your private wealth or some other subject, you will also read this, that whatever allocation that you do now, let's say I'm at 30, whatever allocation that you do for me now versus whatever allocation that you do when I'm going to be 60 will be totally different. And you need to keep on changing those allocations, because my preferences would change, my liquidity requirement would change, and my financial condition would also change. Right? So you will get another question somewhere else, maybe not here, that on what are the different time, and then you would also, if you have studied private wealth management or somewhere else, do you see somewhere it's what do they say? In time horizon, they say it's a 2-tier time horizon or 3-stage, 2-stage, 3-stage, multi-stage.
Okay.
Right?
I didn't come across that.
So you would read this somewhere else, I'm sure, where they say that if somebody is at 40, then there will be 2 stage of time horizons. One is from 40 to 60, and second one is from 60 onwards, because after the retirement. So before retirement, post retirement. Okay. Now, if look at this one, they have a multi-stage time horizon. Why? How am I calling it as a multi-stage or 2-stage or 3-tier or 2-stage or 3-stage? How am I calling that? I'm just trying to understand how many times do I have to change my allocation? Right? Look at this one. In this same question that we are studying right now, in this, whatever I'm going to do, I have immediate requirement in another 2 years. After 2 years, things would change. And then from 2 to 8 years, because in the 8th year, I have another major liquidity requirement for the campaign. And then from there till 60, till these people is going to work as lawyers. Then from 60 to 80, because on the 80th year, they again have to, pay for the scholarship. And then 80 onwards. So it becomes multi-stage. Okay. So I hope you got the idea that these stages, these things are all dependent on how many times I'm going to change my allocation, depending upon how many liquidity requirements do I have, which comes as a major change in my portfolio. Is that okay?
Yeah.
Then they say, let's look at some of the different companies, etc., and what are the different factors that they look at. So they when it comes to insurance companies, what are the different things that they need to keep in mind? By the way, let me tell you, insurance companies have a mandate of investing into FIs. They have a mandate, and most of their investment is into FIs. In fact, I think I told you this before. Previous times they had a mandate of 95%, but since there's a lot of competition and there are a lot of cashbacks in the insurance, there are different offers that they give you. So in fact, they will have to invest somewhere in risk assets so that they can get more returns and give those returns or those benefits to the consumers. That's the reason they now have around 75 to 80% of the allocation in fixed income, and the rest can be equities or some other risky assets. But again, their idea is not to earn money, but their idea is to meet the claims. This is something which is very important. But if I look at pension fund, in pension fund, what is more important to me, that I have to look at the funding cost. What does that mean? I need to understand if my assets is more than my present value of liabilities.
Yeah.
Right. Then I have to see how much do I have to fund, if it is overfunded or underfunded. And I also want to understand what are the different features that I have in my pension fund. We talked about VRS, voluntary retirement scheme, etc. So if we're gonna have these kind of features in my plan, then obviously I will have to set aside some of the amount for liquidity. That if somebody comes up and avail that service, yeah, I should be able to pay that. Okay. One thing I just want to mention, this is a little generic. You can argue, Ankur, let's say they have 100 rupees.
Yeah.
And they set aside 20 rupees for liquidity, while 80 as such usual. So this is for those people who want to explore that feature, right? So they are investing 20% into some liquid investment instruments and 80% as usual. Now you can argue, Ankur, what if everybody will go for VRS? Right? How will that happen? So do they have to really take care of those aspects as well? That what if the cash flows are high? Right? So let me tell you, they don't. The reason are twofold. First, the whole financial system of the world goes by the underlying and the assumption that at one point in time, not everybody is going to get their money out of the bank. Right? This happened with Lehman Brothers, right?
Yep.
Lehman Brothers were Dubai isliye because everybody started extracting their money from the bank and they couldn't afford it. But even if you look at every bank,
No, yep. I'm saying, yeah, correct. Bank run.
Yeah, so I'm saying basically every bank, SBI is like koi bank tha. They only have 5-7% liquidity because they assume that not everybody is going to take their money. But if everybody will starts asking for their own money, the banking system, the whole bank system would crash. Right? Also, if they keep too much of cash, I'm calling it cash. By cash, it's not about ek number or do number, white versus black. Cash basically means that you have liquid money.
Yeah.
If you have too much of this, there's something called as cash drag. You will read this word a lot of times in your CFA Level 3. Okay? And मतलब कैश ड्राइव मतलब हम लोग एक हिंदी में बोलते हैं कि घर में जो नकद पड़ा हुआ है वो क्या दूध दे रहा है, मतलब इट डज मीन रख के कोई फायदा नहीं है, या तो उस पैसे को इन्वेस्ट करो या तो खर्च करो. There is no point keeping the cash because it's not giving you anything. So when they say that there's a lot of cash drag. So I do just to cover one situation, I don't want to keep too much of the cash in my portfolio. Rather, I would invest it somewhere. Okay?
Yeah.
To be honest, I'm not really looking at your book right now. And I'm मतलब ये सब इतना बार पढ़ा हुआ है कि I'm just telling you whatever concepts are coming to my mind related to these things, right?
Yeah, that's
and I'm saying you read this in somewhere in your level 3.
yeah.
All right. There's the next one that they talk about is endowments and foundations. We talked about this, that originally they have long-term horizon, and the payouts are pretty low. The expectations are low, and they don't have a mandate to spend, apart from being tax-free status, right? Well, nobody's dependent on them. But if there are, obviously things would change. We talked about this, right? One of the lines says, in some countries, they have a minimum required annual distribution or socially responsible investment required to maintain a tax-exempt status. Idea is the same, that sometimes you have to just distribute some percent, and that's about it. Then you have sovereign wealth funds. Again, you can imagine that they are wealth funds. They create wealth. So these funds are not here to meet assets versus liabilities. Those are pension funds. So they are pretty much to create the wealth, right? So they say again, this is again very long term and can take aggressive approaches if it wants. Okay. Then the next topic they talk about is tax. Right. So it just goes by a simple rule that, by the way, let me tell you, not sure whether you know this or not, there was a time when dividends were used to tax at a very low rate versus capital appreciation used to tax at a very high rate. Just to give you an example, if a stock price is 10 rupees, and you know, right, if the company gives a dividend of 1 rupee, the stock price will be 9 rupees, right? You understand this part?
Yeah.
I'm saying a stock price is 10 rupees, and if the company gives you 1 rupee dividend, the price will be 9 rupees. On this 1 rupee, let's say the tax is only 5%. However, from this, in fact, let's just take the same example. Take the same example that you invested at 8 rupees, then the stock price becomes 10 rupees, and it gives you 2 rupees dividend. So there are two scenarios. Scenario one, where you get 2 rupees dividend, and obviously then no capital appreciation because the price will then be 8 rupees. Versus scenario two, where there is 0 rupees dividend and 2 rupees capital appreciation. If you look at these two examples, two scenarios, you would realize that from a investor's perspective, overall profit that he got is 2 rupees only. But in terms of after tax return, they are very different, because this was at a 5% tax, while this was at a 15% tax. Right? But then with time, the difference between the tax on the dividend versus tax on capital appreciation, it reduces a lot with time. It reduces a lot. So obviously there is still a difference, There's still a difference, and the dividends are being taxed at a lower interest rate, right? But it was huge then, and also the interest income on basically fixed income or the coupon, sometimes it is being taxed heavily. So basically, they say that whenever you invest into something, it is all you should always consider your tax bracket and the investment that you are doing. So they say when you are heavily taxed already, if you are in the 30% bracket,
Yeah.
you should think about investing into tax-free assets, tax-free products. But if you are into low tax bracket already, you can go for taxable products. Is that okay?
Yeah. That's okay.
And also, there are ways that you can do a tax defer. We'll talk about what are different tricks of deferring the tax. You can also defer the tax. We'll talk about this in some time. But I want to talk about one thing now. एक मिनट में point आया था बताने का. हाँ. मतलब I'm just teaching you this theory, but in real world, at least in India, I can tell you, because I have done this a lot. In real world, so if you are in 30% bracket, think about this. Obviously, when you study CFA, you think of applying those things on your real world.
Yeah.
And you will think about tax-free products, right? But you know what? The tax-free product is giving me 10% return.
Yeah.
But the taxable is giving me 18% return.
Okay.
Or maybe let's talk about 15%. So if it is giving 15% return and this is 10%, I'm gonna get 10% as it is. On this, I will be paying 30% tax. 30% tax translates to 4.5.
Yeah.
If you reduce 4.5 from 15, how much will you get?
10.5.
10.5. Isn't it still better than tax free?
Yeah.
ठीक है. So I'm saying कि although I'm teaching you this from a CFA perspective, but in real world, when I tried to explore these opportunities, I realized कि यार tax दे के भी benefit है. ठीक है. And I can give you another example that they say that if you should invest into liquid funds.
Yeah.
Right. Where there is no exit load if you have a liquidity requirement. मैं कहता हूं invest into risky funds which have an exit load of 1%. Now think about this. And मैंने सब बहुत ज़्यादा किया है. I'm telling you this because I've done this a lot.
Yeah.
Right. So I'm saying that you invest into a liquid fund where it gives you 0.5% per month. Right. Versus
Yeah.
I have invested for a month. I told you about credit cards payments, right? So I invested into some month where it gave me 1.5%. Or sometimes it is in fact 2% per month. So it gives you 2% per month, and if you give a 1% of exit load, you can still earn 1% more than 0.5%.
Yeah. Yeah.
तो मतलब मुझे कभी 1% का exit load तो कभी ज़्यादा लगा ही नहीं, 1% का exit load, and I have no reason to keep my money for an year because it says the 1% exit load is for up to an year, and then after 1 year there is no exit load.
Yeah.
You want money in your 6 months, in your 3 months, if you can get a handsome return of let's say 5% or 6%. Okay, if you can get 6% in 3 months, 1% दे दो यार, 5% अपने हाथ में है, क्या बुरा है 3 महीने में. It is as good as 20% at least in a year. Okay, so I'm saying these things are theoretical, but when you apply these things in real world, it is a little different. But the point that I'm trying to make is that every time you look at any kind of investment, it's important that you look at after-tax returns.
Yeah.
Look at this one. It's a simple question. An investor subjects to income tax on the interest earned at a rate of 40%, considering investing in a bond with a 5% coupon that is expected to be held till maturity. What return should the investor use as an input into the asset allocation process? Okay.
Point.
So jump.
Yeah, 0.6 into 5%.
Absolutely, which is 3%.
Yeah.
ठीक है ना? बस यही है.
Yeah.
Look at this one.
Got it. And then let's just it'll be 12.64%.
Perfect. Perfect. Easy stuff.
Yeah.
It also says that when you look at any of your investments, and ये हम लोग real life में भी करते हैं, they just give this in theory, but even in real life we do that. So they say when you invest into something, always gauge if or always calculate selling now versus selling after some time, which one is more beneficial.
Selling
Right?
now.
Yeah. No, I'm saying you need to weigh that out.
Oh, okay.
You need to weigh if selling now versus selling later
Yep.
will give you the maximum benefit. Right? So think about this. You have 6 months. So basically you invested on day 1 and then 6 months and then another 6 months. So they say you are standing over here and you are now thinking, should I sell now and pay the tax, or should I keep the money in the product for another 6 months, because after 1 year the tax rate would change. It does come in a long-term investment then. Should I wait for another 6 months, and then in that 6 months how much volatility can happen to my product and how much tax rate can I then have to pay. Then if I can get some dividend, or maybe if I have to keep the capital appreciation, paying tax now will be beneficial or paying tax later will be beneficial, right? So I'm saying that they want you to do the analysis before you actually take a decision, that paying now versus paying 6 months later, and then you discount it back to present, obviously, because you are doing the analysis over here. So you need to see whether paying now or versus paying later will give you more benefit. Okay. And one related point that I also wanted to mention with regards to this. Yeah. Another point is, think about you are in December. And let me tell you, you will also read this somewhere else, not obviously in this subject. If you are in countries like US, where the financial cycle runs from January to December, you would see that there's a lot of sell-offs in December. You know why?
Because like tax loss harvesting.
Yeah. So what they say is, let's say you invested something at 100 rupees, huh? And it is currently running at 70. Currently, today is sorry, today is 31st of December, and tomorrow is 1st of Jan. Right? You sell this today and you buy this tomorrow. How much fluctuation can it happen? Maybe 70 to 71. That's about it.
Yeah.
But when you sell at 70, you actually saved 30. Isn't it? Why? Why am I saying that you saved 30? Because if you have profit from some other assets, it is going to offset or reduce the taxable income by 30. Shall I re-explain this concept again?
Yeah, just one more time.
Yeah. So think about this. Your revenue is 200. right? Your cost is 100, your profit is 100.
Yeah.
Tax 30%, right? So you will have to pay 30 in tax. Okay, so far so good.
Yeah.
Now you have an investment for 100 rupees. It is currently running at 70 and you sold it. So basically your realized loss is 30.
Yeah.
So while your taxable income was 100, it has now reduced to 70 now.
Yeah. Yeah.
So 30% on 70 is how much? 21.
Yeah.
You had to pay 30 before, but now you are paying 21. So you save 9 rupees. And then assuming the market would not change on 1st of Jan, you again bought at 71 or maybe 70 itself.
Mm.
So just by doing this, just by selling now, you actually save 9 rupees immediately. Does it make sense now?
Yeah.
That is the reason a lot of companies, they book loss. That is the reason a lot of companies, they book loss at the end of financial cycle so that they can save tax. Okay? But don't forget, our income tax department is too smart. Okay? I actually invested in IFCI. This stock called as IFCI. And I invested when it was around 45. I invested heavily. Heavily, मतलब पूरा margin पे लिया था. And I actually bought 1 lakh shares. And then it went up to 70. And I used to tell my dad, कुछ घर खरीदने को पा रहे पापा 5 लाख, बोला पापा 5 लाख एक्स्ट्रा आ रहा है, हाँ कोई बात दे देंगे. मतलब मैं उतना हवा में उड़ने लगा था. क्या है, the market opens and then it just market open होती थी and my profit is 3 lakhs. But then I didn't understand कि ऐसे stocks में जहाँ पे you see a upper circuit, the day starts falling, it becomes lower circuit.
Oh.
वो डायनामिक्स में कभी लाइफ में देखी नहीं थी. मार्केट खुलती थी सीधा और क्या होता है, पहले 20% होता है, फिर 10%, फिर 5% कैप. ठीक है, 5% कैप मतलब मार्केट ओपन होती थी 5% अपर सर्किट. मार्केट खुली 3 लाख का प्रॉफिट, मार्केट खुली 3.5 लाख का प्रॉफिट. And then from 70 it starts going down with a lower circuit. ठीक है, lower circuit. It opened at around 51, I guess 51, and then मेरे को लगा कि अरे stable हो गया, and then it will again start going up because I have seen 20-25 lakh rupees profit. तो अभी मुझे बहुत दर्द आ रहा था 5 लाख का प्रॉफिट देख के. मुझे लग रहा था कि अरे मैं 25 लाख का प्रॉफिट देख चुका हूँ, मतलब 5 लाख में मेरा कैसे होगा अभी. आई जस्ट वेट and I kept waiting. उसके बाद फिर से lower circuit and it actually came down to 25. ठीक है. And then I started doubting myself कि अरे यार, फिर then I started reading more about IFC. Sometimes a lot of times I just went by my hunch. And then I realized कि IFC के पास कोई projects ही नहीं है, वो तो सरकार के टुकड़ों पे पल रही है. It's a government company, whatever and whatnot, right? And then on March 31st, I thought, okay, I think that's a good way. I'll buy on 1st of April, and on 30th of March, I sold at 25 lakhs, 25 rupees rate. I sold everything, and I made an immediate realized loss of 20 lakhs. It was hard on me, but I thought, okay, यार कम से कम 20 लाख का नुकसान है, कम कहीं तो benefit होगा. Then I went to my CA and I said, 20 लाख को adjust कर दो. They said, adjust क्या करना है? Stock market is different. Your income is different. So you can only offset the loss from the gains on the stock market, not on the total income.
Got it.
पता ही नहीं था मुझे. मतलब 20 लाख यहाँ भी गवा दिए और वहां भी कोई बेनिफिट as it is, and that 20 lakhs loss was of no use, right? So I mean they are smart enough that they don't accommodate, but technically यार मुझे I don't believe, again ये तो कहने की it's a bigger discussion कि हमारे देश में क्या होता है सब गलत है, but effectively all the income that I'm getting through should all come in the same thing, my profit.
Yeah.
Because whatever I'm investing from my salary only.
Correct.
Then my profit and loss should be accommodated in the same way, but then they don't. Okay.
Right.
So again, I'm not talking about how the taxation system is good or bad, but the idea here is that you should always weigh how much selling now versus selling later would fetch you overall profits. Okay. The idea is to